Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. All the comments and subscribers, I greatly appreciate it. This week up, we're going to take a look at Advanced Micro Devices, AMD. As part of our three-part series, we've done Intel, we're doing AMD, we're going to do NVIDIA after this. What we're trying to do is figure out, does AMD make cash, and if so, how much? And if we bought it today, how much can we earn out 10 years if we held the stock? Ready? Let's get to work. Now, before we dive into AMD, let's review the 5 key attributes that we use in this channel to value all the securities. Number 1, top-line revenue growth. We've got to have it. It's got to be there. Number 2, EBITDA growth. We want to see earnings, enterprise-level earnings growing. Number 3, free cash flow. We want to see strong free cash flow. Number 4, low debt, less than 3 times debt to EBITDA. And number 5, a well-priced stock. What is a well-priced? It's well-priced if a conservative forecast produces a market-beating return. That's what we want. I don't want to risk a whole lot by showing a huge growth curve and buying into that. If something happens, it's going to fall, it's going to hurt my investment, I'm going to lose money. But if I put a simple conservative investment and let the stock price come to me, that is a more rational way of valuing a security. That's what we look for as a well-priced stock. All right, let's dive into the security analysis. The first thing I want to do is remind everyone to read the 10Ks for AMD and make sure you understand the products they make, how much cash they generate. All the information is in the 10K. This is my vlog. It's my personal opinion. It's not investment advice. All right, so here we go. AMD, this is 9 years of historical revenue that I've pulled from AMD. 2013, $5.3 billion of top-line revenue. They've gone up to basically flat for the last 8 so years, and then they picked up and almost tripled in the last 3 years. That significant growth has led investors to believe it's going to continue, and it's driving up the stock price. Now you can see here, they've got EBITDA has followed that same pattern. Good for them. The revenue is growing, EBITDA is growing, margins are being held. I like to see that. That's great. But what this does do is for revenue is up 15% on an annualized basis over this period of time, mostly because of this giant jump right here. EBITDA is also up very large with 140% growth year over year here, skewing the numbers up. They actually lost money for a period of time back in the day and have been largely flat here with giant spikes more recently as they finally kind of got their technology on point. But the idea is, can that continue? Let's figure it out. Let's take a look at enterprise value. See how much debt they have. Debt is almost zero, which is great to see. They had $2 billion, and actually with all the earnings they've received, all the cash money they've made, they've paid off debt. I like to see that. And they're storing up cash. $3 billion, $3.1 billion of cash on the balance sheet as of the last 10K filing. And look at this market cap. Holy Jesus, has this thing moved. It was a nothing stock, $2-3 billion earlier in the decade. It has absolutely exploded. $176 billion as of last fiscal year is huge. And enterprise value is very heavily weighted in market cap because these cancel out to be zero. So they're sitting at $174 billion of market cap, of enterprise value, up from only $4 billion earlier the decade. It's incredible growth. Let's cover net debt to EBITDA first. So here they had debt, they were over levered. They've grown the business, paid off, debt is now zero. That checks our box, we like to see that. Enterprise value to EBITDA is absolutely huge. 43 times earnings. That means it's a 43-year payback if they weren't to grow. Obviously, people are expecting this stock to continue to grow, and we're gonna have to grow that forecast in line with that to see if it pays off. But 43 times, 63 times, 60 times, those are big numbers, big multiples, and it makes it's concerning. If they can't live up to their growth, what happens? I will tell you that market multiples do come down. Look at Facebook recently, got halved. That stock got whacked because people just said the growth isn't going to be there going forward, and instantaneously the market multiple changed in that business, and it's now worth a whole lot less. It's also happened to Microsoft. If you go back to my video and take a look at Microsoft for the last 30 years, when the dot-com bubble crashed, their market multiple created by more than 50%. So I definitely think that having a high multiple adds to a level of risk for a business that might be growing tremendously. But let's keep going. Let's look at cash flow. All right, so the cash flow statement of AMD is also very, very impressive. They started off burning cash at the operating entity level. turned it around in these years, making a little bit of scratch, and then absolutely exploded following EBITDA. $3.5 billion of cash money that they made last year selling their products. That is outstanding. It's so outstanding I can't even compute the compound return because I'm going from negative to positive. CAPEX grows, but not nearly as fast as cash grows. So I'm expecting a whole lot of cash to land on the balance sheet. That's what we're seeing with the cash reserve. That's basically where this is coming from. They're minting cash so fast, they can't even come up with capital investment projects to spend the money. And then debt is zero. They paid it off. We saw that. They had debt up here. These are all negative, so they're paying down debt, and they ended up with zero debt on the balance sheet, which is this number. That's because of all these negative numbers on the cash flow statement. When I sum these up, I get cash flow to equity owners, and it's been largely negative for the entire duration of the period, mainly because negative CFO, CAPEX plus debt payment. Only the last 2 years was this number positive. It will probably continue to be positive going forward. They're doing quite well. If I put this on a per share basis, they've actually been issuing shares over this time. That's how they funded that growth, the negative losses. They were issuing shares to fund those losses, and it paid off well. The investment that they made, the dilution to shareholders worked. They were able to properly invest that money and have produced amazing returns for the investors who bought the stock. Now they've got a whole lot more stock. It's going to be harder for them to grow that earnings. So far, $2.6 is the cash flow to equity holders that they generated. Very, very good for them. On a dollar basis, the shares are roughly $143 a share. So it's yielding very little, 1.8% cash. All right, let's forecast this business. All right, let's forecast this business. When I look into the market and get forecast for AMD, the market's calling for a 30% growth rate. Even AMD themselves is issuing very strong first quarter guidance. I'm basically taking that and annualizing. I get about a 30% growth rate on earnings. That puts EBITDA at $5.2 billion. Now, I'm bringing that down, but still a very, very strong growth rate every single year for a decade. Not till it gets sub 10% do I would consider it kind of a conservative investment growth rate. This is very strong, very hard to do in a competitive landscape, but they are forecast to do it. You go from $5 billion to $17 billion over this time. That's a more than tripling of EBITDA. Now, the one thing that I did here is I brought down the market multiple 10 times versus what it is currently 43 times. Why? Semiconductors in general trade for a lot less. This one and NVIDIA are the two that really trade at a high premium. A lot of other semiconductors trade at single-digit multiples, not 10 times. So I'm still giving them a premium to market, but I'm saying as they scale, as competition comes up, I expect that market multiple to come down as growth rate declines. What that does is it says $17 billion of EBITDA gets me $174 billion of enterprise value. No debt plus little cash gets me $177 billion of market cap. Divide by the shares outstanding is $144 price target out 10 years for AMD. Cash flow per share. Now you saw that what they generated was high cash flow per share because there's no debt. That's fantastic. I'm going to carry that forward because they don't have any debt. CAPEX is relatively minimal, so anything in EBITDA should pass through to the equity holders, and I can grow this the same way I can grow EBITDA. And what it does, it basically almost triple, 3.5 times the cash flow per share, $11.24 per share. I apply a 5.5% yield to it, which is still probably fairly low yield, and I get $204 per share. Okay, now we can look in the stock market. When I look out in the market, I can see I can buy as much stock as I want. It's $113 a share. And what we have here is we have an estimate of $174, basically splitting the difference between the two valuation methods. One with free cash flow, this one with an EBITDA market multiple approach. They get a little disparity there, and I average it for $174. Let's review the IRR for this investment. So what I have here is the investment cash flows that it produces. It's your pro rata share of the cash flow. The cash flow is very strong. They have no debt, very low CAPEX. I expect their earnings to pass through, and we're growing those earnings at 30%, 25%, 20%, very, very fast every single year for a decade. This is a strong stream of cash flow and is dependent on that growth rate. I can buy the stock right now at 113. I think I'm going to sell it at 174 out a decade. That produces an 11% IRR, which in my opinion is not enough to put the money to work right now in the stock market, which is still very richly valued with Fed's fund, with the interest rates going up. You're going to see growth stocks come down, especially market multiples are going to come down. And I think that's the biggest risk here. This stock trades at a very, very high premium to the cash flow that it generates, or EBITDA. You can use cash flows multiple or the EBITDA multiple. But at 43 times, we have seen stocks that trade like this that come down over time. And when they do, no matter how high you grow earnings, you're now trading those earnings at a much lower multiple, and that's going to weigh on your risk, on your return. So for me, a risk-adjusted basis, I don't think the stock is cheap enough for me to buy it. I like the stock, but I can't give it a good rating. Let's review the five key factors. Number one, top line revenue growth. Yes, very, very strong. Number two, EBITDA growth. Check the box. It's growing. Number three, strong free cash flow. Absolutely. Number four, low debt. Yeah, there's zero. Fantastic. Number five, well priced. No, I don't think it is. I'm going to give it a meh. Why? Because the company is a wonderful company. But there's two things we need to consider when we're buying a stock. One, is the stock a wonderful company? Yes, in this case it is. Number two, is it well priced? No, it's not. It's too expensive, and there's too much downside risks if the market contracts and multiples come down, that this stock simply won't recover because the multiple is not going back up to 43 times. So now let's put this into a spectrum. If I buy it now at $13 a share, it's $113 a share, it's 11% return. If the stock price comes down sub 100, I like it even more. And that, in fact, I'm a buyer. If it goes up, I'm still not a buyer of the stock. I'll wait for a better price. If you like this kind of review, this kind of analysis, definitely check out my website, cashflowinvestingpro.com, where I teach a financial course on how to become an analyst, how to do this for yourself. You can do this. There are over 3,000 stocks in the public market. Nobody can analyze all of them, but you can analyze the ones that you're interested in and that you know the most about. Take the class. I give you the Excel sheet. I walk you through the evaluation of Apple. I show you how to read 10Ks. I show you how to pull the data apart, assemble a model, build a forecast, estimate your future price target, and give you the foundation you need for when you consider an investment. Definitely check that out. You can also join the Cash Flow Club. I produce lots of these one-pagers every week for the members of the club, more than I can do videos. And in that it's 10 years of historical information. I give you the 5 key factors. I summarize it with the growth forecasts and share some insight in the business. Definitely check out the Cash Flow Club. Thank you very much for my review on AMD. I really appreciate the time. Don't forget to hit the subscribe button and throw a comment down below. Let me know what stocks you want to see next. I'm happy to take a look. Upcoming are some videos and other valuations I have done if you're interested in cash flow valuations. Thank you very much for watching the channel. Hit that like and subscribe button. Bye-bye.